right, hello and welcome to another Expert Inside interview. My name is John Golden from SalesPOP, online sales magazine, and Pipeliner CRM, joining you from a sunny, well, actually a little bit of a damp San Diego today. But I'm delighted to be joined by Jeffrey Fidelman, who is over the other coast in Westport, Connecticut. How are you doing, Jeffrey?
Fantastic. Thank you. Thank you for having me, John. It's sunny here, so I'll share the sunshine with you.
Perfect. Well, Jeffrey is the founder and managing partner of Federman and Company, a leading advisory firm launched in 2015 to address critical fundraising and growth strategy needs of early to mid-stage companies. You have deep experience as an interim CFO and COO and guided dozens of companies through pivotal financial transactions. And what we want to talk about today is busting fundraising myths, what's holding startups back. Let's face it, Jeffrey, to a lot of people, especially a startup, they're excited about building a product or launching a service or all of that thing. And the whole financial world, like fundraising, angels, VCs, PEs, whatever, friends and family, it all seems like it's kind of like nebulous to them. And, it's something that it's hard to navigate. So, that's kind of how people approach in their first exposure to it is, whoa, this is a whole other world.
It is, and media doesn't help either. We
Mhm.
see a lot of stories coming out about XYZ founder raising $10 million on their seed round or
Yeah.
$42 million on their Series A or what have you, and it only took them a couple of months.
Mhm.
And oftentimes then you start digging into the details, and it turns out that one of the founders is just spinning out of Meta or coming out of X or so-and-so's daughter or son or what have you. So it
Mhm.
is a journey, to say the very least. But I think just like building a business, the most successful people at raising capital, similarly to at building a business, always have a structure that they put into place and are able to manage that structure with some level of consistency.
Yeah, it's a good point because a lot of people have found, and this is even I've found this in the past, that when you get into fundraising, sometimes it can take over and become like almost like a full-time job in itself.
Sure. Well, I mean, that's one of the jokes that a lot of people say, that fundraising is a full-time job.
Mhm.
And and really it can be split into kind of two or three parts. The first is, call it top of funnel, right? In sales, and I'll kind of use the
Yep.
same vernacular. There's top of funnel, mid, and then at the very end. And really where we focus and where we have found a lot of success with our clients and ultimately how we were able to build a business was to focus on top of funnel.
Mhm.
And top of funnel meaning investor identification, qualification, personalization, doing all of the outreach, managing the back and forth until such point as that investor gets in front of the founder or managing team or management team of our client.
Mhm.
So it's important to keep in mind that just like with sales, just like with building a business, raising capital is really no different in that you need a structured process,
Mhm.
first of all, from how you approach it. And second of all, that you need to constantly be compounding it over time. Raising capital for a month or two, or having the idea that, hey, I'm going to start raising capital and my idea is the best idea since sliced bread, and everyone else should believe that and should see that the same way that I see it, all of a sudden doesn't come to fruition within the first 30 or 60 days. It doesn't inherently mean that you have failed. It just means that, okay, now you're going through the same process that everybody else is going through, and you just need to stay at it.
Yeah, yeah, no, absolutely, and I think that's an important point, is to remind people it is a sale, but you're basically selling your company, your idea to an investor in order for them to place money into it. So, but before you do that, there's obviously you need to make sure that you have got everything in order, like that you're that you understand the fundamentals of your business, that the financials are all in place, the company structure, stuff like that. Sometimes people jump in when it's a little messy, and that's not good.
No, it's not. And you bring up a really good point. So, what do you need in order to go out and fundraise?
Hmm.
And then I'll talk a little bit about kind of targeting and what I was saying before in terms of structure. So, when you're going out to fundraise, really what you need to have is a pitch deck, a financial model, and some semblance of valuation, how much you're looking to raise and how much you're looking to give away for that, whether it's a note, safe note, convertible note, kind of what the
Hmm.
terms look like, or if it's equity, even more so, what valuation you have in mind. But I think it's really important to understand also that, yes, you need to know your stuff when reaching out to an investor. But going back to what we were talking about just now, in terms of targeting,
Hmm.
the one nuance that I would say, and all of our analysts, or almost all of our analysts kind of incoming, are former BDRs and SDRs, and
Right.
not investment from the investment world or for the financial world.
Mhm.
And the reason we do that is, if you think about it fundamentally, when you're in sales selling a software or product, you're calling people who don't really want whatever you're calling them and trying to sell them on. They probably already have a solution,
Sure.
and they can't really understand why, or don't have the time for you to do that. With what we do, or with what anyone listening, and when you're fundraising, as long as you are qualifying and personalizing, and really you're targeting the right people, you're calling someone who is waiting for your call. You're calling an investor whose job it is, and I think this is fundamentally what a lot of people seem to forget when they are raising capital. Investors don't make money by raising capital from LPs or other
Yeah.
investors. Investors make money by deploying, by investing that money and then getting a return back. So when you're calling an investor, and as long as you've done kind of the research and the setup properly, you're calling someone who wants to take your call, who wants to have a conversation with you, who wants to deploy their capital, because that's the only way that they're making money.
Mm-hmm.
So it's really important to keep in mind that as long as you have your ducks in a row prior to reaching out to that investor, as long as you're reaching out to the right investor, and reaching out at the right time, maybe just after lunch instead of when they're hungry beforehand, you should be able to connect and have a meaningful, engaging conversation with them, because they, again, are in a seat of, I have this money, and the only way I can make money through carried interest or anything else is by actually deploying that money.
Yeah, and talk a little bit about the different types of investors or fundraising avenues available to people, because sometimes I think, especially when people hear startup or hear tech startup, they think, all right, gotta run up to Sand Hill Road up in Silicon Valley and run around all the VCs up there and just pitch, and eventually somebody will throw a few million at me.
Sure. Well, that's not a bad idea. So I can't argue
It
against.
doesn't always work. I've been up there a few times.
Yeah. But it doesn't always work in such a kind of a concentrated manner. And what people need to understand is that there are investors all over the country, all over the world. I mean, we typically target investors in the US, and there are angel investors, family offices, angel group investors. There are venture capital funds that are micro and smaller. Then there are mega large institutional venture capital funds. Then there's endowments, foundations, pension funds, and then every category in between. So I guess part of the qualification that I was talking about before is to really understand who you are as a business, how much money you're raising, and even potentially what the next couple of rounds will look like.
Right.
I know it's incredibly difficult to define what your next couple of rounds will look like, how much you'll need to raise, what your valuation will be. But if you're raising $1 million, you should not be going after a super large family office. You should not be going after an endowment or a foundation or some sort of institution. There are some VCs that are micro VCs. So let's call it 100 or maybe $50 million of AUM and smaller. Those would be better targets. So when you think about the investor you're going after, you think about their entire kind of cash stockpile, their portfolio of how much money they have raised or how much money they have to invest out of. And if you're raising $1 million or $2 million or $5 million, they're not going to put, if you go to a fund that has $10 million in total AUM, that's unlikely going to be an investor for you. At $1 million, they're 10%. At $5 million, that's 50% of their fund. And I don't want to use absolutes, but it is unlikely that fund would invest.
Right.
You're trying to go after a fund where, number one, no one fund is going to take, let's say, more than 50% of your round from a risk management perspective. And number two, if you are raising the 20, 40, $50 million rounds, you're not going to a $10 million or $20 million fund, because they simply can't participate in a meaningful enough way to make a difference. If I'm running $1 billion, even if I give you $1 million for your $1 million fund and you return 30 times that, it doesn't make a difference to me in terms of overall portfolio and what I need as a return. So that goes kind of into what I was talking about before. Make sure that you're qualifying the investors that you're going after prior to actually going after them.
Yeah. And then how about, well, there's another thing on investors too. You're saying the right type of investors, but also sometimes I think people overlook realizing that it has to be the right investor, not just the money. The money's great, but you have to gel with them, or you have to understand, are they going to be a highly involved, hands-on? And if so, is that what you're looking for? Are you good with that? Are you looking for a business partner? Are they going to be more hands-off? Are they just going to be, we have these services we can offer you? So understanding the fit, I think, is obviously very important.
Yes. And I personally struggle with this often. On one hand, money is money.
Yeah.
And if you have the conviction, if you're convinced about your business, if you're able to get that investor across the line and they're not really adding much in strategic value to you, but they are giving you money, I think, if you just need money and you have all of the mechanisms you need in place to grow, you just need fuel to the fire, then I think the strategic component of the investor is less important.
Yeah.
Now, on the other side, on the other hand, it's a double-edged sword. However, whatever kind of saying that you'd like to input here, strategic investors are incredibly helpful when they're helpful.
Right. Yes.
I know that's kind of a backhanded comment, but if I'm an early stage company, yes, the relationship between a founder and the investor is incredibly important. Most oftentimes, the investment is made, yes, the investor looks at the idea, likes it, thinks that it has runway, room to grow, but they want to make sure that the founder that they're investing in, that the founder that they're putting money behind, has the ability to execute on that vision, and this is equally as important, and has the wherewithal to pivot if needed.
Right.
And that's often why when you go out to raise capital, you shouldn't be raising capital for 12 months. You should be raising for at least 18 to 24 months on a very early stage company. Because that will give you enough time to run whatever business operations that you want to run or what you had in mind. And it also gives you enough time to fail and pivot.
Right.
And if you only raise just enough money to execute on a very, very specific plan or vision, and then it doesn't work out, as with many startups, things don't tend to work out exactly as planned, you won't have enough time to pivot. And now all of a sudden you're going back into the market to raise capital out of fear, out of desperation.
Yeah.
And no investor wants to put money into a company out of fear or desperation.
Yeah, and if there is one that does, the terms are going to be pretty draconian, right?
Well, then they're buying your business out from under you, essentially. Exactly.
Yeah. So on that point, about figuring out how much money, I mean, that always is an issue too, about how much money do you need? Like, because sometimes people go for the most you can get, or other people be like, no, just get enough. You couldn't spend all that at once anyway. But let's face it, whatever money you get, an investor doesn't want that money sitting around doing nothing.
Sure. So, in a fancy way of saying that is efficient deployment of capital.
Yeah.
Effectively, kind of when we work with our clients in putting together, the financial model, if we're helping them with that, and the raise size, the amount, we also kind of approach it from both ends. The first end is build a model, assume a blank check. What is your ideal? Just forget about how much money you're going to raise or able to raise. Imagine you had all the money in the world, build a model. And then from the other side, let's now be realistic and apply some common sense to it. Do you want to, or do you need to hire 100 engineers? Well, how quickly can you do that? Because if you're modeling, I'm going from 1 to 100 engineers in the course of a month, that's not even a believable statement. It would take, 25 recruiting agencies and probably more than 60 days to actually interview, hire, and go through the onboarding and everything else. So you want to be able to have a realistic component to the amount of money you're raising and how you deploy it. So efficient capital deployment is just as important when you're figuring out how much money I need to raise as the valuation in and of itself. And I always kind of defer back and again, I everyone listening, take this with a grain of salt. It's not applicable to every business, but most often my recommendation is to raise less and more often, as opposed to raising this mega round. And when I was speaking with a client earlier today, and all that happens when you raise a mega round is you put more and unnecessary stress on yourself as the founder.
Right.
Venture funds and venture investors are typically underwriting their investments to 30, 40 times return, meaning they're looking for a 40x return. So if you're raising at an incredibly high valuation, that means that their expectation of a return is that much higher from there. So save yourself the stress and the angst by saying, I'll take a step down in valuation. I won't raise as much money, But what I'll be able to do is prove out my thesis, my theory of what I'm going to do in my operational business, product market fit, go-to-market strategy, distribution strategy, what have you. And then I'll be able to raise more money to pour fuel on the fire, because now my projections are a lot more aligned with reality, as opposed to just some assumptions that I put down into a financial model.
Yeah, and I think that's again, I think a great point, and I think that's a really important point. Again, is your model is to make sure that your model is realistic, that you've stress tested it, all of, because let's face it, you can put a lovely spreadsheet together in Excel, and you can make it do whatever you really want it to do, and you can say, oh, and so I think being realistic about your model, because I've seen the thing what you talk about, like companies say, oh, I just need this money, and I'm going to hire 50 salespeople immediately, and we're just going to blanket the thing, and you're going, yeah, where are you going to find 50 good salespeople?
Yeah.
Number one, and then how are you going to onboard? How are you going to train them? I guarantee you hire 50 salespeople, 40 of those will fall out.
Oh, for sure. I mean, for anyone that's hired, probably kind of we're preaching to the choir at this point. I mean, it's hard enough to hire 1 or 2 good people that stay with you over the course of 60, 90 days, regardless of culture, regardless of anything else. And on top of that, when you're a small company and you're growing, not to say that when you're a large company, every person doesn't count,
Sure.
but every person counts so much more, and there's so much more visibility on every person's contribution, the smaller you are. If you're hiring people, you need to be a lot more, you need to hire people with a lot more intent. And I've read multiple articles. For some reason, this popped up over the past couple of days. Like Elon Musk interviewed the first 2,000 people that worked for SpaceX. Steve Jobs, famously, I just read about this, had a beer interview where he wouldn't sit with someone in an office. He would take a walk with them. First, it would be like a 30-minute walk, and then he would sit down and have a beer with them. And he figured, if I can't have a beer with somebody that works for me, I don't want them to work for me.
Yeah, I could have worked for him. I would have been happy to have a few beers. Yeah, but yeah, and I think that's I think that those are really really important points, because you can get kind of blinded by the money and think of like all the and here's the other thing too, isn't it? All the things we can do when we get that money.
Right.
But that can then dilute your focus. So that's another balancing act you have to make sure the money's aligned with your focus, so you don't start going, ooh, well, now I got that money, I could do something over here that might take your eye off the ball.
Sure. Look, it's the difference between buying a $100 office desk chair or $1,000 office desk chair, or having marble floors, or just having carpet on your floors, or hiring different types of people and then actually making sure that they're doing the work. If you have $100 million in the bank, and again, I mean, investors can kind of see through this a little bit better these days more than before, but you want that efficient capital deployment. So I want to be realistic with how many people I hire, where my office is, how it's situated, but also everything that you do should be done for the benefit of the business, especially early on. You can certainly, do your company retreats in Bali or whatever you want to get once you've proven that success out. And I'm not against that.
Yeah.
When you're building a business, every penny that is generated in revenue, every penny that's raised from an outside investor must be thoughtfully invested back into your business.
Yeah. And I think that's the thing, is you got to think of the investor money like it's your own money, and unless you're completely, spend profligate with your spending, then maybe not. But in the normal way, look at it as your own money. And like you said, is buying $1,000 office chair, is that really a good use of money? Is it really going to make a difference? I mean, one startup I was with, I had a plastic table from Staples and a plastic chair, and that was it for the first while, because that's all. It wasn't a good place to invest money.
Sure. Yeah, of course. I mean, Jeff Bezos, right? He said that his desk was, I think it was a wooden door that he put on books or something like that, and that was his first desk. I mean, and if everybody can do the same thing, then we'll all end up being in the right place.
Yeah. So just one last question. So, if you go back a couple of years back to when money was free, basically, and investment, the driver from investors was all hypergrowth. Don't worry about the bottom line right now, just hypergrowth. And then when things turned a little bit, then there was the kind of pivot to, oh no, you need a path to profitability and sustainability. What are you seeing now? Is it still the focus? Is it balanced out more, or the focus still kind of leaning towards a path to profitability as opposed to just hypergrowth?
No, I think it's a lot more about revenue generation. Yes, growth, but growth as it relates also to revenue and then to profitability, kind of in that order.
Right.
And, one phenomenon that I was seeing, and I've been doing this alone. I mean, we've run this investment bank for 10 years, and then I was in venture just before that.
Right.
And before that, when you had a seed investor, they did what the term of the round implied. They were seeding a company.
Yeah.
And now so many seed investors, if not most seed investors, are requiring founders to have $500,000, $1 million in ARR before they would actually consider them for investment.
Right.
I'm generalizing a little bit, but by and large, the majority of our clients who are raising seed, when they're talking to a seed investor, that's the expectation of that seed investor. And I think that's kind of coupled even more prevalent now with all these vibe coding platforms that are in existence, like Lovable, for example, and a few others, where it is no longer acceptable in this day and age to go out and raise $200,000, $300,000, $400,000 to build an MVP. Again, you have pharmaceuticals and biotech, you have deep technology and quantum computing. All of those, yes, need a significant amount of capital just to figure out how to make it work and build it. But if you're building a software company, there's no reason why you cannot build some version, be it super low tech, low res, in Lovable for a few $100s and a few 100 hours of time, at least to show proof of concept to an investor.
Right.
And at least put into the market some sort of manual version of the product that you'd like to launch. Then once you've had a few clients, some feedback, I think at that point it's perfectly acceptable to turn around and say, look, we've built it out, we've proven the model, we need a few $100,000, few $1 million to hire a sales team to have kind of bolstered in cash so we can run our thesis, and then you can go out and raise capital.
Yeah. So those days have gone since when I first moved over from Ireland. It was during the dot-com era to Silicon Valley, and the days of just putting a PowerPoint together and walking in with no product and getting a lot of money, those days are long gone.
Those days are gone.
Well, listen, thanks so much, Jeffrey. This has been very, very educational. All of Jeffrey's information will be below this video. But before we go, please do remind people about what you do.
Sure. So I run Federman and Company. I'm the managing partner. It is an investment bank specifically for early stage companies and emerging managers. And what we do and how we help our clients raise capital is by a service that we call fundraise as a service. Instead of selling people our phone book or a Rolodex, we've essentially gone out and productized best practices of raising capital. Subscribe to things like PitchBook, Fintrix, Preqin, Dakota, all of those platforms. We've aggregated that data internally, and then layer an analyst on top of that to do all of the outreach on behalf of our clients. So in other words, outsourced investment relations.
Yeah, which is, and I would highly recommend people go check out this service. If you've ever done fundraising, if you've ever been involved in that, it can take over your life. It can be, it can be quite a frustrating and process as well. So I think if you can leverage a service like Jeffrey's, I think it's really well worth it. I would say it would save you a lot of time and angst.
Thank you.
Save you a lot of angst particularly.
Yeah, absolutely.
Yeah. All right. Well, listen, thanks, Jeffrey. Thank you for watching and listening, and I will see you all again very soon. Thank you.
Thank you.